Welcome to Product AMA, your daily online Ask Me Anything. We started Product AMA to give those passionate or curious about product management a daily break, something to look forward to.
Let's get started. Our topic for today is product management in B2B enterprise SaaS. And enlightening us about it, we have Victor Skrylev, who is the VP of Product at Purefacts. Victor is an MBA from the Rotman School of Management. And prior to that, prior to entering this amazing world of product management, he has been in strategy and consulting. Welcome, Victor. Why don't you introduce yourself to our audience? And just as an icebreaker, tell us one interesting fact about yourself.
Thanks for having me. Really exciting to be part of this part of Product AMA. So I'm Victor, and I lead the product management, design, and marketing teams at Purefacts, which is a wealth technology firm based in Toronto, a B2B SaaS enterprise firm. I joined the firm about just a little over a year ago, and we're in a mission to build the next proud Canadian unicorn. I'm confident we're going to achieve that over the next, hopefully 5 years. And before that, I did spend some time in banking sector and marketing and product management, working for one of the large banks, management consulting, and some other roles in the past before. Something that people don't usually know about me, when I was 18, I was very serious about becoming a rock star. I was playing in a band, and I was considering that to be my career. And then my dad actually talked me out of it. He did it in a very clever way. So I ended up going to university and pursuing a degree in economics, and then doing all these things that I'm doing today.
Awesome. Well, you would have looked completely cool in a rock star look, I'm sure.
I'm still a rock star in the heart.
For sure. So Victor, let's start off the AMA with defining product management in the B2B SaaS space. What are some of the elements that make this space unique, and how is it different from typical software product management?
Yeah, good question. So I think fundamentally, and I'm going to borrow a phrase that Gibson Biddle, a former VP of product at Netflix, usually uses, and he says, product leader's job is to build products that are that delight clients in hard to copy, margin enhancing ways. And I think that statement is quite true of whether you're in a B2B, B2C, or other spaces. What of course is different about B2B, and particularly B2B enterprise, because not every B2B is the same either, is that your market is a bit structurally different. First of all, your buyer is not always the user. Not only that, but the bigger your buyer is, the more people are involved in making a buying decision. So you have buyers, influencers, you have users. Your buyer typically represents a larger portion of your sales. And as a result, the larger the buyer, the larger is their buying power, which often creates that friction in companies between doing what my client is asking me to do versus solving for a market need that exists. And you generally have smaller number of buyers, which makes your discovery a bit different. You have limited use of quantitative tools, unless you're going for the users, for example, where you have a lot of users, but still the buyers may be very few. So you tend to rely a lot more on the qualitative type research and discovery. That kind of qualitative research is also kind of unique because it depends on whether you're talking to the buyer or the user or the influencer. None of them have the full picture of the problem you're trying to solve. So you usually need to piece it together and be a bit more thoughtful about how to find patterns across different clients and so on. Your sales cycles are really long, particularly in the enterprise space. You could be spending anywhere between 6 to 18 or months or even 2 years, which usually means that the product decision you're making today will probably not pay off until next year or the year after. So it's not like you can just release it out, see how it works, and then make decisions beyond that. You also have a really big dilemma, which is in the enterprise space, the word MVP is not really well received, because your enterprise clients don't want an MVP. They want to have a fully functioning, value-producing product. So you can't just release something really small, learn from it, and then release the next version of it. You still do that, but your cycles are much longer, and the quality of those MVPs becomes, the standard for quality becomes really, really high. Of course, you're internally, even within the company, you have a bit of a different set of stakeholders. In the B2C space, you typically would have, a really strong marketing team, lead generation, demand generation. In the B2B space, first of all, you have a sales team, which you don't always see in the B2C space. And the sales team does the magic work that I could never aspire to do. They sell to enterprise clients, and it's a very difficult job. And your marketing team becomes more of the kind of the account-based marketing team. You're being very, very targeted about who you're going after and how you're going after them. So those are some of the elements that make B2B, and particularly B2B enterprise space, a bit different.
Yeah, and like that's an interesting point you mentioned about, the sales cycle being so long. So the product decisions that you take today might or might not be valid a few months after. And I think my next question is related to that. And before I ask that, to people who have just joined, feel free to ask your questions in the Zoom chat below, and we'll be taking them up very shortly. So Victor, in a B2B SaaS environment, there are so many phases that a product manager experiences: fixing or adding features for clients, interviewing them for discovery, leading the product development, and so on. So how should a product manager be prioritizing in this space and avoid getting influenced by those few high net worth clients?
Well, I feel like you to some extent already answering the question within a question. So your key priority, and that's maybe a bit unique in the B2B space, when you have a product management team, and you usually don't have a product management team until you're probably, a 50 people type organization, maybe 30. A lot of your product decisions and visions are usually made by the founder or the founding team, I would say. And then only after you reach a certain scale do you really typically have a proper product management discipline. And what's unique about having a product management dedicated team is that this is the team that can truly dedicate their time to understand the market. So creating a very repeatable, frequent discovery cycle where you do discovery every week is really critical in understanding the total market. And usually the firms that, especially the firms at the enterprise level, that tend to create great value in the market by solving meaningful problems are the ones that can access that market insight fastest and do something about that market insight fastest. And again, I'm talking about this long sales cycle. So faster means a bit different understanding in B2C versus B2B, but understanding something today, and then in 3 months, you're launching a meaningful feature or a product for the market that can go then into a sales cycle, and then in 6 months, you're starting to see it pick up. That type of cycle in general starts with very thoughtful discovery. And I think that's where I would spend, especially if you're a brand new product management team in a B2B space, that should be your number one priority in building the market insight that nobody else in the company can truly get to, because usually the way you structure these types of companies, there's a tendency to be more professional services focused, meaning you have teams that are usually dedicated to a client or maybe a few clients, and they really understand well that one client. But your strategy usually goes beyond just one client. You have to definitely wow the client, but then you have a markets or segments of the markets you haven't yet reached, or you have new geographies you haven't reached. So you have to do a lot more than just focusing on one client and doing discovery across a wide segment of issues.
All right, awesome. And I do see a couple of questions popping up, so I'll just go ahead and pick one of them. Here, Lee is asking about user personas. So can you describe how your team manages persona for users versus buyers in a B2B setting?
Yeah, it's a good question, and I'm not going to claim that we are the best at using this tool effectively to help us out. So there's definitely a lot of learning that's happening for us as well. Generally, we would have probably about 4 different types of personas. Just looking at our overall product suite. Typically, our product suite is used by, we're in the wealth management space, so it's used by advisors that are helping their clients ultimately live a better life from a wealth management perspective. You have back office users, people that support those advisors in operating their business. And in some cases, we have investors that the advisors serve. So we have 3 types of users that typically use our platform. But behind the scenes, you have also buyers, people who make ultimate decision on buying the platform. You have influencers. And it's usually a combination of some sort of a business executive and a technology executive. And then depending on just how large the client might be, there could be all kinds of other layers in between or even across that you need to take into consideration, such as, we're in the financial services space, we're fintech, so there's a lot of regulations we also need to keep in mind. So at some point, you're probably interacting with a compliance or chief operating officer or a regulatory risk type individuals and so on. So the way we structure our personas is around whether it's a buyer and the user and the type of user, and then ultimately what is the function or the key value driver for them in either using or buy our platform.
All right. There's another question from the audience here. Damanjot is asking about the sales cycle, and he says that since the sales cycle is so long, it's typically around 6 to 18 months, as you mentioned. Do you pitch a new idea to potential customers before implementation for getting better user perspective?
Yes, and it's a double-edged sword. In some cases, in the B2B space, sometimes you can have a new product idea or a new feature idea that you do believe is going to be valuable for the market. And you go and start pitching it to maybe a few clients, and then the clients might actually decide to co-sponsor or co-invest with you in this idea, so they can accelerate that feature to market and create value. So there's certainly a little bit of that. You also run a risk, of course, is that once you have paying clients that you pitched an idea that you haven't yet implemented, is that your design decisions will start to sway towards meeting the need of an individual client or maybe a group of clients. And then you realize that you're now accumulating technical debt, or you're ultimately just building the wrong thing for the market. And it becomes something you can't scale beyond. So there's good pros in that approach, because you sometimes de-risk some of your investments as a result. And there's cons because you need to make sure you understand and be very clear on the problem you're trying to solve. It has to be a market need problem, not just an individual client problem. Because ultimately, when you're building a business, your objective is to build a business that will produce great enterprise value for yourself as well as for the market and the economy in general. Usually investors or buyers of your company will pay you a good multiple on your recurring revenue when what you built can be resold dozens, hundreds, thousands of times. So you have to, that's a balancing act for sure.
Awesome. And there's another question here from Anchor. She's asking about, how do you manage customizations on your product suite for specific enterprise clients you might have? So if one client wants specific features, do you roll that features across all the clients just to keep your product code centralized?
Yeah, that's a good question, and it's I know where this question is coming from a place of pain, so I understand where it's coming from. So, in the way we today have operate our product is it's a single code base, and a single code base implies that even if we're doing something that may be a bit unique to this client, we would implement it through a configuration. as opposed to a customization. But even then, I think there needs to be a bit of a shift of the mindset, which is often a very difficult journey for companies that have been incredibly successful at running these professional service type business and building great business models using this type of business, to start shifting the scale more towards a product mindset, or in other words, from solving a client need to solving a market need. And in those cases, when you consider making decisions around building something for an individual client, often you don't have the discovery cycle built into the time to really validate whether this is a market-worthy idea or is a client-worthy idea or just specific client idea. You do need to be very thoughtful on how you price these types of engagements. You not only need to consider the effort to build, which of course everybody considers. You also need to consider the effort to maintain, which often gets missed. But even if you didn't miss that, you also need to consider an effort, not an effort, but opportunity cost. Because if you look at a lot of the companies that have been very successful at building high growth, impactful SaaS type businesses, typically what you would see is that these companies spend, roughly 20% of their top line on R&D. Or simply put, product investments. And what this implies is that for every dollar of product investment, you're expecting roughly a $5 payoff. So about a 5x. And if that's how you think about your smaller professional services engagements, or maybe smaller features that your clients are really asking for, you always need to consider that I'm going to build this. And in the worst case scenario, this is going to be the only client that's going to use it. I'm going to build in my effort. I'm going to build in the effort to maintain it, because every time you change the product, you have to regress test and do all the things to make sure it doesn't break. And then I need to overlay my opportunity cost, because I know that a $1 of that investment needs to give me $5 in the future. And if I can't get there because I can't resell it, then I need to make sure that I price it on the premium that justifies doing this type of work. You also, of course, because it's a B2B and you have a lot of, it's really a relationship business, not just a transactional business that it becomes. You need to consider that in some cases it is worth doing one or two smaller features because you're building the goodwill with the client and your relationship grows and it goes into cross-sell of that relationship or a deeper relationship. So as long as you're very strategic about how you use these types of opportunities to grow your business, deepen your business, and ultimately get that dollar to give you $5 back, that's when you could really create a value for your business. And doing these configuration makes it worthwhile.
Awesome. And another follow-up question on the professional services aspect. How do you work with professional services to look for productization opportunities? And if so, how do you evaluate and prioritize against other innovations?
Yeah, that's a great question. So ultimately, professional services job is ultimately to delight the client that they're working with. Whereas when I look at the product management's job, we have a 5-year, 3-year, whatever it might be, strategy on where the company needs to end up in those 5 years. And that includes, the total revenue you want to create, what's your makeup of a recurring versus non-recurring. If you know that you need to get to that level, how many new customers do you need to onboard? And then therefore, how turnkey your implementations or onboarding of new clients needs to be. You understand the segments you play today and what you're known for today, and then which segments you need to go and enter and what you want to be known for tomorrow. The key to prioritization when it comes to looking at product is understanding how the things that professional services engagements do align to your broader strategy. Because at the end of the day, you're probably similar to us. You're trying to build a great, proud Canadian story of a unicorn company that's not going to just operate in Canada, but it's going to be Canada rooted, but operate in US, UK, and globally in general. And that is the vision you're trying to drive to. So in some cases, professional services or engagements align quite well to doing that. In other cases, they're your gateway to that kind of vision. And in other cases, you need to invest in something completely different to go in there. But you need to not collide, but find synergies between the two worlds, the professional services and the ultimate product vision you're trying to build and the business you're really trying to build.
Great. As a reminder to our audience, feel free to keep asking your questions, and I'll be taking them up. And Victor, shifting gears here a little bit, and I believe measuring success is essential for any product manager, wherever you are on whatever product you're building. As a SaaS PM, what sort of data and metrics do you look at, and how do you measure success for your products?
Yeah, and that's a great question. I think, again, I'm not going to claim that we're experts in using data to our advantage yet. I think we are also going through a bit of a transformation. I know that from a product perspective, or even more a little bit higher level, from a business perspective, we are trying to build the next Canadian unicorn. We know roughly what revenue level we need to get to in order to justify that type of valuation. The next part is understanding under which conditions do buyers or investors pay you a multiple of 6, 10, or 12. And it's usually 6 things. The first one is you have a proven technology that is hard to copy. And proven technology is a code name for you have sales coming in and they're sticky, right? The second part is you can maintain fairly high growth rate year over year. What's a bit unique about our company is that we've been profitable in every year of our existence. And with that in mind, as you look at overall growth trajectory, in VC world, you sometimes use what we call rule of 40, which means you want to grow your top line and your bottom line, and together that growth needs to create about 40 percentage points of growth. So in other words, if you're growing 20% on the top line, I want to see 20% on the bottom line growth as well. If you want to grow 40% on the top line, I'm okay not seeing profitability on the bottom line. With that in mind, you need to basically look at the sustained growth year over year. Are you able to hit 20, 30, 40, 50%, whatever it might be for your specific business in a sustained manner year over year? The third component is repeatable sales. So is your product, so if I'm an investor and I'm going to give you $5 million and I put all 5 of these $1 million into sales and marketing, I can scale easily. And if I can do that, then I'm going to pay you a 10x on that investment. What it means from a product management and strategy perspective is every time I onboard a new client, I'm not doing any customizations. Or at least little customizations. Sometimes you have a massive enterprise deal and maybe it's worth doing a couple of customizations or configurations. But in general, if you're trying to onboard 100 clients over the next 4 or 5 years, you need to ensure your product can be as turnkey as possible. And in some places, in some markets, that's a very difficult problem to solve, usually related to the data sources. If you're creating data as part of your platform, that's a lot easier. But if you have to integrate with other systems, that's where you see a lot of challenges. The fourth part is I'm going to pay you as an investor 10x on your recurring revenue if every incremental sale goes almost entirely to the bottom line, which is basically your gross margin is 95%. Because then I can take that 95% and reinvest it into sales and marketing, then I continue to grow, right? That's kind of the idea. The fifth thing is high client retention. So you're not constantly in the acquisition game, right? You acquire a customer and you can maintain them for 3, 5, 10, 12, 15 years. That's pretty common in the enterprise space, especially if you have a really big, valuable piece of technology. Nobody wants to replace big pieces of technology frequently. So you stay in the game for a long time. And then the last piece is about that recurring revenue makeup. So typically in a big enterprise SaaS businesses, you probably want to shoot for 80, maybe 90% of your revenue in total being recurring. And then the rest of it is, you call it professional services. And even then your professional service is not about making customizations or configurations. It's about implementations, upgrades, consulting, how to use our software better to generate more value in your business. If you can do those things, then you will create the enterprise value. Your product will create the enterprise value as a consequence of creating tremendous value for your client, right? So if those are kind of the highest business level metrics that we would look at, and then you start to create proxy metrics. So your proxy metrics for repeatable sales is, I'm going to look at my last 10 deals, and I'm going to look at how many of them required any kind of customization and configuration. So it's not, again, it's not a statistical science here, but it's facts you need to always keep in mind as you continue to grow your business. If we're talking about validating whether I was right about reselling that feature I built for one client to another 12 clients, tools like Mixpanel, Heap, Amplitude, Pando are great ways to validate if anybody even cares about those features. You should probably always look at your total feature set. Let's say you have 1,000 features on the product, of which, of course, there's probably going to be, 200, maybe 20 that are used 80% of the time. And then everything else is kind of a mixed bag. And then you overlay the size of the account on those, and you understand a little bit better about, having a few features here and there that create tremendous value for us and the client maybe is okay. But as soon as I start to look at some of the clients or segments of clients that are potentially not as strategic for your future growth, but they're really important for you to still delight and wow today, then you're going to think about your product strategy a bit differently as well. So that's kind of the idea. So you have your big business layer of metrics, then you have your proxies that are usually within the usage of the product, or reselling of the product, and so on. And that is the way we connect the value or decisions we make today to the value we're going to create tomorrow.
And Lee is making a very nice comment here that this answer nicely fits with the product market fit metrics, which I agree. Like it's quite overlapping. It's synonymous. All right. We have another question from the audience here. Anka is asking about what percentage of your ROI do you allocate to R&D efforts to build new products or major features?
I assume the question is about what percentage of revenue.
Yeah.
Is that fair?
Yeah.
So generally, if you look at the majority of SaaS companies, you probably see about 20% allocated, but it does range quite a bit, anywhere from 10 to 20%. I think it really depends on, again, your strategy and your current market position. If you have a product that right now you're competing in 20 deals and your win rate is quite low because you're constantly facing the same competitors and they keep stealing your deals, there's clearly an R&D that is well due. In other cases where you can have an outstanding win rate on the deals and the product is strong, the feedback from users and buyers is strong, your renewal rate is super high, you probably don't need as much investment. It's about maintenance of the product and finding one or few things you want to continue to create differentiation on, so you can protect your market share or maybe grow your market share to some extent. But it really depends, right? It's not a rule of thumb that everybody should invest 20%. It really depends on the market position, especially if you look at companies that are IPOing. You probably see a bit of a spike in R&D right before the IPO, so they can enter the market on a strong position. And then they start to level off a little bit more again on the 15, 18, 20%. There are some companies that go 40%. It's really unique to the market in which you're in, the size of that market, the solution that the problem and the solution you're trying to take to market, and your competitive set. In some cases, for very niche markets where you have a very niche problem and very niche solution, and maybe you have one or two competitors, you don't need a 40% R&D to outperform them and still do quite well in the market.
All right. Another question about the AI and big data solution vertical that you have. Can you tell us more about it? What is the organization doing in this space, and is this a new product offering?
Yeah, there is no doubt that in the next decade or so, there won't be a wealth management firm that doesn't use AI in some shape or form in their business. And I think out of all the industries, wealth management is probably one that has been falling behind on AI adoption. You probably see quite a bit of it on the investment management side. So robo-advice, building portfolios, using quantitative methods and things like that. But you see very little of it on the actual advice business, as in giving advice, not just for your investment management, but your goals in life, aggregating your total or getting your full picture of your assets, not just with me as a TD financial planner, but what do you have in your pension funds elsewhere? What do you have in your other accounts outside of TD and things like that? So creating the total picture, total advice, and using machine learning or in some cases deep learning to produce insights that are going to help you live a better life and accumulate more wealth so you can go and pursue your wildest dreams, whether it's philanthropy or starting a business and things like that. I think it's definitely going to be a huge market category in wealth management in general, everywhere, but wealth management in particular. And the way we look at AI is you have kind of a unique situation in wealth management where over the next 2 decades, you're probably going to have an unprecedented amount of wealth transferred from the current generation to next generations. And that shift is going to be quite radical because the consumer expectation is going to change, overnight. And the consumer expectations of the new generations are quite different than the traditional wealth advice model, where they've grown with tools and experiences outside of financial services or even in financial services that set them up for this frictionless experience. They start to challenge, why can't I get that high-end total advice that someone in the high net worth space can get in terms of their tax planning, estate planning, business planning, their personal investments and things like that. So why can't I get it even though I don't have $1 million, $2 million, $5 million in investable assets? And I think AI is going to create a big shift in this market. It's going to democratize a lot of that high value advice, that total advice, not just investment management, but total advice, and do it at a cost that is reasonable for the industry to truly create value for the new segments in the market. And we're placing a pretty big bet on that market segment. We've started working on a brand new platform last year that ultimately tries to accelerate adoption of AI solutions in the wealth management space by doing 3 things very well: aggregating data, let's call it 80% out of the box, which is often one of the biggest barriers in AI adoption in the first place. Second is deploying pre-trained value-proven models. And the third part is retraining these models over time as we accumulate more data or we add richer data to the data set. And if this platform is truly successful and can prove itself over the next, let's call it 12, 18 months and ready for full-on commercialization with heavy investments in sales and marketing, we believe we're going to be part of this important mission of democratizing advice, wealth advice, and making it accessible to individuals around the world that, quite frankly, don't have access to that type of advice today. So that's our vision there, and I wish I could share a little bit more on it, but I think we'll wait until our product is in a better spot where we can truly show some wins there.
That's all right. And I remember when we were chatting earlier and we were talking about the impact of COVID and AI, and you mentioned that AI is helping you for client outreach as well. So,
Yes.
Apart from that, what sort of, changes or trends you have seen that the current health crisis has brought to your organization or the industry?
Yeah, so I think first of all, Purefacts is incredibly fortunate to be in the position we're in today. We're fully bootstrapped. We're profitable. We have a product that's incredibly sticky. It's a mission critical product for a lot of wealth management firms. So we've, knock on wood, haven't experienced a major downturn because of the virus, but we do recognize that a lot of our clients have experienced an incredible change to their life. Lots of the firms that we support, the revenue model is a fee-based model, which basically means that they charge you, let's say, 1 percentage point on your total assets that they manage for you. And we all know what happened to the markets. So, over a month, 2-month period, they lost probably 20% of their revenue just like that. And that's one of the reasons we decided to take one of our specific use cases in AI, which is a prediction of investor potentially leaving their advisor, leaving the firm in the next 3, 6, 12, and 24 months, and offer it as a free opportunity for our clients to build up their call list, because everybody was doing the same thing in this environment. They ultimately called every client they had on the list to make sure that they can reassure them that this is certainly an unprecedented time, but this is the time when you cannot act irrationally. And you need to build in some, of course, the safety nets from an investment management perspective and so on. And client outreach is really key right now. So we offered it to all of our clients as a free opportunity, where we basically take the data set and we apply our model on prediction of churn. And we give out the list of all clients that are at high risk of leaving. And we give reasons, the drivers of why we believe these clients are at risk of leaving, because everybody's unique. And that's what the power of machine learning. For every client, the drivers of them leaving could be unique. And machine learning allows us to identify those drivers.
Awesome. So to the audience, we have 20 more minutes left with Victor here, and it's been a great discussion. And I'm going to continue with the questions. Feel free to drop in your questions as well in the Zoom chat window. Victor, there's a question in the chat that has come up regarding the regulations and the governance around AI models, especially around to avoid bias built in it. So what is your company doing to comply with that?
Yeah, that's a very good question. The ultimate, I guess, bias, and at least the data set that we're working with, is you're trying to predict the future based on the past, and the ultimate assumption is that the past is predictive of the future. Which of course, and we are lucky enough to have some data back on the 2008 situation. Kind of, we had that black swan event, or whatever you want to call that, and it created an unprecedented fluctuation on the market, volatility, and then we have this happening again in a kind of different way, but still happening. So when we look at our data with the techniques we're using, tries to replicate as much as possible a realistic scenario where I look at my past and I predict the future, and then I go kind of fast forward the time, and then I go back to that future to validate how accurate we were. So that is one of the ways to at least manage the bias around what I'm observing today is going to be predictive of the future. And in at least the financial markets, if you look at that data in financial markets, there is a huge history of data. So we certainly have a benefit to see these patterns repeating themselves, and can feel a bit more confident about managing for this type of bias. There are, of course, other biases that are more human-driven biases within the business. Some advisors or some specific investors might impose a bias on the data, and just because of how they manage their business or how they approach their business. There, the benefit is, of course, is in machine learning can be really powerful in identifying key patterns without you trying to dictate to it what to look for. And in particular, of course, it's around the specific techniques you're using with the data to understand what you're doing. So ultimately, everybody knows about the example of where if you show a deep learning algorithms a bunch of pictures of dogs and then you show them a landscape, it's going to see dogs everywhere. So you're trying to prevent that, of course, and we have a wide variety of different types of data to allow us to catch these types of issues.
All right. Moving on to the working and hiring aspects. So I'm sure you work with a lot of PMs and you hire a lot of them. What do you think are the top skills that B2B PMs need to excel in their role? And what qualities do you look at when you're hiring such PMs?
Yeah, that's a good question. So I think, first of all, I think every product leader's job is not necessarily to hire for a cookie cutter approach. It's to hire for diversity, diversity of thought, diversity of experience, backgrounds, and so on. So every time I think about hiring somebody new on the team, I always look at my current team, identify the gaps that I need to solve for, and that's how I look for the next person. So there isn't really a standard formula. But you certainly see some patterns specifically in the B2B space. In the B2B space, especially of discovery, and a repeatable, frequent discovery is core to how you're going to understand the market. You need people that feel incredibly comfortable sitting in front of a CEO, COO of a large organization and having a discovery conversation to understand what's on their mind as they think about their business. And with the same comfort, do it with users, influencers, and so on. In our case, the domain knowledge is quite important. You could be talking to an advisor, and talking to an advisor is to some extent a lot easier than talking to a back office person who is trying to tell you how they have a pain point around processing performance fees and the different algorithms and calculation of those fees and how they need to constantly make adjustments to it and so on. It's a different level of conversation. So you need to understand enough about the business, both from investor perspective, advisor perspective, the back office user perspective, the buyer, the influencer, and so on, to be able to be very effective in the discovery phase. So, but the discovery is the core component. The other piece that is really important is when you work in the B2B space, you're often, especially your buyer's benefits, tend to be incredibly tangible. It's the ROI. My advisors are going to spend less time doing this one task, and therefore that's why I'm going to buy your product. Or I'm going to produce better outcomes for my investors and therefore grow my business, and your product helps me do that. That's why I'm going to buy your product. So all of these benefits tend to be a lot more measurable. So the product managers that typically succeed in the B2B enterprise space have to be really pragmatic, right? Because you hear a lot of bank executives or large organization executives saying, words like seamless experience and one-stop shop and that type of verbiage, which is all great at framing the problem. But at the end of the day, seamless experience means that my advisor spends 30 minutes less every day preparing for a client meeting because they don't have to navigate to one system, another system, or the report is available right away and things like that. Time to insight is cut and things like that. So you need to have a really pragmatic mindset on how you measure value of the product decisions you're making. And the third part is probably really important across all product managers in this space is the influencing skills. I think influencing in general is really critical in any product job. Your ability to inspire others, whether it's clients, your teams, external, internal stakeholders. But the influencing becomes even more amplified in a B2B enterprise space because you probably have not hundreds of thousands of clients, but maybe 50, maybe 100 clients. Your sales team is intimately knows every single client. You have to influence your internal stakeholders, help them position conversations differently, help them understand the value of one feature versus the other feature, how to talk to their buyers or influencers, how to demo the product better, what to highlight, and things like that. So your ability to be effective as a team player in that type of environment is really critical. And the influencing skills become even more so critical. So I would say those are the three, at least, buckets that are really important across the board. But ultimately, there's a myriad of other things that every product leader or manager needs to be really good at. But at the end of the day, you don't need to be good at all of them. Just find a few that you're really specializing in, and bring that skill set to the team so you can fill in the gaps that exist.
Amazing. This next question is by Harman in the chat, and he's asking, how do you stay on top of market trends? Do you actively take out time from your day, your daily schedule to stay on top of market trends or opportunities?
Yeah, it comes back to discovery. So there's some stuff that is part of your primary research, and then there's quite a bit of secondary research you need to be constantly staying on top of. There's some obvious stuff, of course. You have your key thought leadership type publications. You probably need to sign up for them. There's a daily news stream or news email, whatever they might be sending you. You're probably always scanning through it on a daily basis. There are some white papers, research papers. Lots of consulting firms typically cover your market. You need to understand what they're talking about. Your own network. I have invested quite a bit of time building network in the consulting space with companies like Deloitte, EY, PwC, all of those firms. They can offer your personal connections there, can offer you an insight that is not easily visible in the publications that they're sharing with you. Especially if you think about competitive research, right? It's super hard in the B2B enterprise space to do competitive research. You can't just go sign up for a free trial and just look at their product. You need to understand what they do, and the way you do it is through somebody who has seen their product, whether it's your client, your prospect, your discovery sessions, when you ask questions like, how do you solve this problem today? Or what are the alternatives you've considered? And what was good about them, what was bad about them. You have a lot of industry reports like Gartner and things like that cover your competitive landscape as well. So I do believe it's a daily activity because at the end of the day, you're going to win and you're going to help your company win as a product leader if you have the best insight into the next most valuable problem you should be solving.
Right. Another question. So going back to the discovery phase, Anka is she's on a roll and she's asking another question about the discovery aspect. So she's asking, how do you recruit users and people in the industry to participate in your discovery phase? Is it usually limited to the pool of people that you are currently doing business with?
That's a great question, and I would say we're still on the journey to make it a bit more. To reduce the level of selection bias that is always associated with going to just your own clients and who you know. There is kind of two methods, I guess. One is you hire a professional research company. It's usually expensive, but it's often worthwhile if you're making a really big product decision, big bet. Spending $50,000, $70,000 on a good research may be very, very valuable for you. And usually what you would do there is you kind of be the ghost listener on a lot of those calls, so you can hear what the actual users and buyers could be telling you, and bring along your design team and your engineer tech leads, because you're all going to hear a different thing from the same exact person. So of course, that's if you have the budget and the decision is worthwhile to invest that type of money. On the other side, if you're building this kind of a recurring weekly, I'm talking to at least 2 users or buyers discovery phase, We've so far we tried things like the what is it called, usertesting.com. So you can sometimes find and recruit people that are kind of within your segment. In our case, it's a bit a little bit more difficult because we're a bit niche. Like it's harder to find advisors or investors that you're really trying to get to. We've used LinkedIn in the past. Just searching on LinkedIn, approaching people with a little script that you say, hey, we're thinking about some new ideas. Would love to talk to you about understanding your pain points and how these can help. Reassuring them this is not a sales call. I'm not going to share your name or number or email with my salespeople. So this is truly a discovery phase. I just want to understand what you're doing. In some cases offering a little bit of an incentive. Let's call it, I'm going to make $100 contribution to a charity of your choice, or other types of incentives. So LinkedIn could work well. We have in the past considered doing more of the advertising approach. So if it's a bit of a larger market segment and you know that by having 1,000 impressions, I can probably get 10 people or something like that on the site that is very, very targeted to them. Let's call it, wealthmanagement.com or something like that. Then you can consider doing recruitment yourself through an advertising channel. And sometimes it works, sometimes it doesn't, but it really depends on what is your ultimate recruitment criteria? Who do you really want to talk to, so you get a kind of a broad range of perspectives. So it's a lot of hustling. I'm not gonna lie. Like, you have to be creative about who you go to. Your clients and people with relationships you have with your clients is certainly an easy channel to get to some good quick insights, but you do need to over time build up a broader network, so that you're not always biased to who often your biggest clients are, or your most engaged clients are, or your existing clients. Ultimately, especially if you're going and pursuing new markets and new segments, new solutions, new products, you're going to need to expand your network.
Right. I really like that thing that you mentioned about donating money to charities. That's something that I've heard for the first time. That's really innovative of using this way of doing discovery. And I think we're almost wrapping up now. And I have to ask you this question. In retrospective, if you were in the early years of your journey in product management, what advice would you give to yourself? What sort of things to focus on, and what mistakes to avoid?
Yeah, it's a great question. So I think the piece that I wish somebody told me, maybe 10 years ago, just accept that every brilliant idea you're going to have is going to be at least 80% wrong. And the game is not about having the best idea or even coming up with the best idea. The game is in iterating until you can find the best idea. And whether it's leveraging your internal teams that might have good insight, or leveraging your clients, users, buyers, whatever it might be, you ultimately just need to accept that most of the time you're just wrong. And that's perfectly okay. Because if you know you're going to be wrong, you're going to approach the problem solving a bit differently, and you will ultimately find the right solution for the right problem.
Yeah, just to add to that, like, fall in love with the problem, not with the solution. That's
absolutely.
That's a saying that always goes. So, thank you, Victor. This was amazing. This was such an interactive session. Got lots of questions from the audience coming in. And again, Victor, thank you so much for joining us today. It has been a pleasure to chat with you and host this AMA. And everyone, enjoy the rest of your day. Take care, stay safe, and we'll see you soon.
Thanks very much. Take care.
Follow Product AMA on Twitter and send us your topic suggestions. We look forward to seeing you soon.